Hello everyone. In this session, I'm going to talk about the role of factors in the investment management process. Wherein some of the important aspects that I'm going to look at is what is the process of value investing? What are those value stocks? How do I identify those value stocks and invest in those value stocks? Then we'll try to look at different kinds of risk factors, especially the macroeconomic. So when you talk about inflation, it's a macroeconomic risk factor. When you talk about the interest rates, it's a macroeconomic risk factor. So these are the different macroeconomic risk factors. So corresponding to those risk factors, how do I look at the risk premiums? What is the kind of risk associated with each of these macroeconomic factors, and what is the level of risk premium that is associated with them, and correspondingly what should be the asset returns associated with those assets which are exposed to these macroeconomic risk factors. Then there is a special focus in terms of understanding the volatility risk, which is again one of the macroeconomic risk factor. But in a portfolio, how do I really mitigate the volatility risk? And all these things we will put in a multi-factor model. The various risk factors, again we talk about dynamic, the change over time. So these various dynamic risk factors, if I am putting in a multi-factor model, how do I really look at it? Especially with the example of a Fama-French model, which typically has three major factors as a part of its model apart from the market. Right, we know the Fama-French model talks about three major drivers of the return, one being the market returns, and two, the difference between the small and the big. So the size of the firm, and then the market value to the book value of the firm. So looking at these, how are we typically talking about the capturing of the dynamic risk factors in a multi-factor model? And towards the end we will focus on momentum investment strategies. Right, something going an upward trend will keep showing an upward trend for some more time. That's a typical momentum investment strategy. Something showing positive correlation will continue to show a positive correlation. Something moving in a downward trend will continue to move in a downward trend. That's a kind of a simpler way of putting the momentum investment strategy. So let's get into the first aspect, the process of value investing. Some of the important statements which we already know. When I talk about value stocks, if I compare it with their net worth, which is the book value, their market value is much lower. So in short, if I am looking at the market value to the book value ratio, this would be much lower for these value stocks. Right, so they are like more and more underpriced kind of stocks. Whereas on the other side, if the market value to the book value is much higher, we call them to be the overpriced. So that's the definition of a value stock. Whereas on the other side, when we talk about the growth stocks, they are more and more expensive because they are already growing. They will continue, they are expected to grow in the future. So they become more and more expensive, and even if you look at the market value to the book value ratio for the growth stocks, it is already much higher. Whereas for the value stocks, that ratio is much lower. So if I look at it historically over the past data, value investing in those stocks whose market value to the book value ratio is much lesser, to a large extent we have seen that this kind of a strategy has been doing really well across the period. Only there are a few instances like the financial crisis of 2008 or something happening very weirdly in the economy. The tech boom that has occurred during the late 90s, financial crisis of 2008, these were the situations where the value investing has lost badly. But otherwise, if you look at it on an overall scale, value investing has done really good. Now, one more important observation is majority of the value stocks, they move together. So almost all the value stocks, they all show similar kind of a movement. If you try to look at the correlation between them, it would be much higher. Because all of them, the commonality between them is they are exposed to similar kind of the market dimension per se. So once I control for the market exposure, the way the market, the value stocks move, almost all of them, they move in similar kind of a manner. So either if they grow, they all are growing. If they fall, they all are falling. That's the correlation is much higher after you control for the market exposure. And we know the value investing is again a risky because they are already underpriced. I want to invest in those kind of stocks. So it's a risky, but again the whole risk is shared by all the value stocks, because if they are not providing any diversification benefit, but in some cases that risk can be diversified. But in majority of the cases, they all move together more or less in the same direction. And they are all exposed to similar kinds of market factors altogether. So when I am looking at the factors, I can control them. I can classify them into either macroeconomic, fundamental economic based factors, where I can look at economic growth, which is the GDP growth kind of a factor, which is more common to all the value stocks in the economy. Similarly, inflation is going to influence all of them in a similar manner. The volatility of the economy, the volatility of the index as such is going to impact all the stocks on a similar manner. Then again, the productivity, the demographic risk, changing demographic profiles, they all come under the macro and fundamental based factors. Whereas there are other set of factors called investment style factor, where we talk about the market, how the market is moving, which is more like a static factor. But various types of dynamic factors also are there from the investment strategy or a style perspective. So we keep changing the styles of investment from time to time. The composition of the securities which we are investing in keeps changes from time to time. So that is what we are associating to investment style factors. So this is how the value investing typically happens. Now, when I look at the various macroeconomic risk factors, so a few important bullet points. When an economic growth slows down, which is the economy is in a state of recession, or if the economy is in a very high inflationary phase, almost all the companies in the country, almost all investors, they are badly affected. We have seen the 2008 scenario. Almost all the stocks have fallen. So these kind of things, the economic scenarios, especially the negative economic growths, or very drastically falling economic growths, or very high levels of inflation in the country, they are going to impact the firms, investors and everything. But at the same time, if you see the other side, consumers wise or investors wise, they don't like low growth. They want the country to grow much faster and faster. They want fast moving economies, fast growing economies. So these two are not anticipated by any customer or investor. So they don't want a low growth period, or they are not interested in a high inflation period also. But look at the other side, the debt collectors, right? Someone who have lent. For them, if the growth rates are much lesser or if the inflation is much higher, they are going to benefit from the high inflationary period. Even someone who has invested in oil wells. So the debt collectors typically are getting benefited from slow growth because the value of their loans are going to go higher. So that is what they are going to benefit from. And even the owners of oil wells and all, they are going to benefit because of high inflation, because the price of the final product is going to increase in the long term. So there are some sections of parties who are going to benefit from a slow growth phase as well as from a high inflation phase. But in regular scenarios, regular customers and investors and firms, they don't like low inflation or low growth or high inflation. So whenever there are bad outcomes for macroeconomic factors, as we said, one, the growth rates being very low, it's a bad outcome. Inflation very high. So that would also account for the bad times for the average investors. And one more important point we need to understand is majority of the macroeconomic factors that we have discussed, whether it is inflation or interest rates or economic growth or any of them, they are generally persistent for some period. If there is a period of low inflation this month, it may not suddenly jump to high in the next month. So we could see a few continuous periods of low inflation as such. So something is persistent at least for some period of time. If some negative trend started in any of the macroeconomic factors, majority of the times you see that that negative trend is going to continue for some more period. So there are some cases where we anticipate some kind of movement, where we expect some kind of movement, and anything that is expected is already bundled into the overall pricing part. So while doing the pricing for the individual securities, the expected movements of the macroeconomic factors are already taken into consideration. But what are generally more riskier or more problematic are the unexpected changes. So I expect that the inflation will be, let's say, around in the range of 3 to 5%. So as long as the inflation levels are around this, we might have already expected it, we might have already considered them as a part of the premium pricing, etc. But if the inflation is increasing or completely unexpected, so going much below this or going much above it, so that if the inflation shock is much higher than what has been anticipated, that is when we are talking about a bad time to the investors, and even the asset prices getting very badly impacted because of that. So as long as things are expected, fair enough, enough care might have been taken to address them, but only when it turns into an unexpected shock kind of stuff, that is when the bad time starts, asset prices fall. Let's look at the perspective of economic growth. So if I look at it from a perspective of economic growth, let's talk about a scenario of low economic growth. So where the recession is much higher. Now during this period, all the risky assets, they perform very badly, because investors who are holding risky assets, they want to sell them off. So there is something called flight to safety. So almost all the investors want to move towards safer investments. So the end product is they try to buy all those treasury bills and other riskless securities and try to short or sell off those securities which are very risky. So the prices of all the risky securities are going to drop drastically during the recessionary period. So during that time, the volatility also will be much higher for those risky securities. Less risky ones are going to do better during that period compared to high risky securities. So this kind of a mechanism is much better for those investors who are prepared to weather recessions relatively comfortably. So there are some set of investors who are who are prepared to face the recession. For those guys, it's not a problem at all, because for them, they are still investing in risky assets. They know that during some period, especially during the recession phase, the values of their investments are going to go down, but their focus is majorly long run. So these risky securities, they are expecting that in the long run they are going to be benefited for them. Even in the short run, if there is a possibility of 1 or 2 periods of much worse returns, but still in the anticipation of more higher positive returns in the long run, they don't mind investing in these risky assets. Whereas when you talk about a scenario where the economic situation is bad, all these risk-less securities like government bonds and highly rated AAA kind of rated securities, they perform very, very well. That is what I said, flight to safety. They do well during these periods. So for those investors who are completely risk averse, right, who don't want, who are not in the anticipation for very high return, but at the same time they don't want to take big risks, they don't want the value of their portfolio to fall below any below a kind of threshold. So for those kind of investors, obviously choosing the government bonds would be a much better option. But it has been found that investing in less risky securities over the long run, the benefits are not that evident. In the short run, investment in government bonds and less risky securities looks appealing, whereas that's not the case in the long run. So a simple point for us to understand is, from the economic growth perspective, if I look at the recessionary period or the periods where the growth rates are much lesser, irrespective of whether that securities are risky or less risky, you will find that the returns are much more volatile during those periods. That's one common characteristic that we have observed when the economy is not doing well. Similarly, when I look at from the perspective of inflation, wherever the inflation is much higher, almost all the securities, irrespective of stocks, bonds, etc., they are all going to be badly affected, because if the inflation is higher, the expected return also keeps going up. So if the expected return goes up, the value of the security, which is the discounted value based on the expected rate of return, is going to fall drastically. So the asset values are going to go down for all the securities, nothing to do with stocks, bonds, etc. So every security is going to be badly affected with high inflation. And when I look at another important macroeconomic risk factor, the volatility, if the volatility is increasing drastically, the stocks are going to perform very badly. So highly volatile stocks, they perform very poorly compared to less volatile stocks. And we can also talk about a leverage effect. So there is a negative relationship between the volatility and the returns. If the volatility of the stock is going to be much higher, the returns are expected to be much lower. So when there is a kind of a drop in the stock returns, obviously I cannot cover the margins also. When the stock returns fall, I need to cover for my margins. So there is an additional borrowing that is going to increase. So the overall financial leverage is increasing, because if you see simply the debt versus equity, stock prices are falling, the debt does not change, equity has fallen, so the debt to equity ratio is going up in that case. So automatically we see that the leverage is increasing. So that's what we are talking about, an opposite relationship between the financial leverage and the volatility of the firm. So when the returns are falling, the leverage is going to increase. So when the volatility is increasing, obviously the investors expect more returns because the overall risk is increasing. So the risk is increasing, the equity investor starts expecting much more returns for the risk that they have taken. So the required return for the equity investors also goes up. And also the discount rate is also increasing. Expected return is going up, means the discount rate is increasing, which means the present value of that equity security will fall. So the stock prices have to fall because the present value of that equity has fallen because of the increase in the discount rate. So that's the kind of a linkage you could see. Even from the bonds perspective also, if you look at bond returns and the volatility index, compared to stocks, this correlation is lesser. It's not that it is not existing. In case of stocks, stock returns versus VIX, the correlation was much higher, whereas when it has been looked at with respect to bonds, slightly lesser. So which means to some extent bonds are safer, but again, because it's not completely completely overcome kind of a scenario, when the volatility is there, to some extent I can mitigate myself by going with the bond investment, but again it is not completely eliminated, which also says that the bonds need not be a complete safe haven when the volatility is very, very high. Then coming from the policies perspective also, in case of high volatility, the investors cannot even know how the government is going to respond. What are the kinds of policy changes that the government is going to bring up during the financial crisis? So there is a heavy uncertainty that is floating around. And when the volatility is much, much higher, it crosses a certain threshold, the losses can be very, very severe. Right? So we have to understand one simple point in this context. There is a lot of negative linkage between the volatility and the returns. Not only of a couple of assets in isolation, but even of the portfolios and any kind of investment strategies that have been taken. So whenever we are seeing a period where the volatility is much, much higher, during that period, rather than having a very big positive movement in the stock, we see periods where the movement is very, very negative or more on the downward side itself. So that's the reason, and volatility understanding is much, much essential as a part of the portfolio construction process. Now that we know volatility is one of the serious risks in the investment management process, we also need to know what is the way out to mitigate the volatility risk. So if I am more and more allergic, averse to volatility, compared to my investment in stocks, I should look at investing in bonds. So bonds are less affected by volatility compared to the equity stocks. So I can increase my holdings in the bond, that's one. Or nowadays we have so many securities that are available in the over-the-counter market, the derivatives. So either I can use put options, which give me an option to sell off my stock or sell off my underlying if the price falls below a certain value. Or I can look at a volatility swap. So I am exchanging some X amount of money for every unit of actual volatility greater than the expected volatility. So I will check whether the actual volatility is higher than the expected volatility or not. So if whenever the actual volatility is increased more than the expected volatility, for each unit which is excess, there is some amount of payoff that I am receiving in this process. So those are such kind of different instruments that are available in the market, which are protecting the investors against the volatility risk. So we see that volatility risk is something investor is very seriously considering. So they don't mind paying a premium for that rather than trying to bear the volatility risk when it is occurring. So to a large extent, they don't mind investing in the put options. So whenever the price of the stock is falling, the put option comes into picture, which will protect them against the falling price. Because we have been talking about volatility being a factor which will impact the price negatively. Most of the times it will result in a fall in the price, which also means that the returns are going to be negative when the volatility is higher. So when I am trying to sell volatility, right, I am anticipating that the volatility will be much lesser. When I am selling volatility, I am a seller of volatility, I will anticipate a profit. I will get a profit when the volatility is much lesser, when the stock is fluctuating in a very limited region. Whereas the buyer of the volatility is anticipating that the volatility is going to be much higher for this stock or for this index. So he wants to protect himself against that heavy fluctuation. But as a seller of volatility, I will be thinking that the buyer should lose. So for me, the payoff scenario is the volatility is much lesser. So that's the reason, as a seller of volatility in any of the volatility swaps or any other volatility based instrument, if I am playing the role of selling volatility, then I'll be making more and more profits when the economy is stable, when the volatility is much lesser. Whereas when the volatility is much higher, like a scenario of a crash, then as a seller I'm going to lose quite heavy. So because selling volatility is more like selling a risk protection as well. When the risk is much lesser, the seller is going to get a benefit. But when the risk is much higher, it's always obvious that the buyer is going to be benefited in the process. Even if you look at another example of selling volatility, a short volatility strategy, even the rebalancing of the portfolio also looks like a selling volatility. Because when the volatility is much lesser, I keep doing rebalancing, then I'm going to be more and more benefited. But when the volatility is much higher, when I do a rebalancing of the portfolio, I'm going to lose very badly. So the rebalancing over the assets does not directly trade volatility risk. So we are not directly getting involved in trading volatility. But the more and more I'm trading in derivatives market, trading the volatility, so the volatility risk premium is actually increasing. Whereas in case of rebalancing, that is not working at all, because in rebalancing there is no question of additional premium. So the losses in trading volatility in the derivative markets are much steeper, whereas in the rebalancing the losses of trading volatility are much lesser. I am selling or buying volatility. So because I am not directly buying or selling volatility, I am buying or selling the underlying securities whose volatilities are different. Whereas if I am directly involved in buying or selling volatility in the derivatives market, I could clearly see that selling volatility or buying volatility, there is a heavy additional risk premium that is coming into picture. Whereas when we are doing a rebalancing as a portfolio strategy, it's not impacting my overall volatility. So we are, if I talk about a pure volatility trading in derivatives, which can very well be performed without looking at any expected returns, I can directly get into a delta hedging strategy where I am trying to make sure that the delta of the portfolio is neutralized to zero, taking the long and the short positions accordingly. So that's the kind of a way. There are two major ways in which I can mitigate the volatility risk. One, I can take the help of the derivatives market for reducing the volatility risk. Two, I can play on the rebalancing as such. So depending on the situation, appropriate strategies can very well be thought of and implemented. Then, looking at the dynamic risk factors. So till now, whatever are the market or macroeconomic based risk factors that we look at, whether it is the economic growth or inflation, volatility, they are all more of a static factors. When I am looking at the dynamic factors which keep changing over time, CAPM factor is the market portfolio. So if we look at majority of the macroeconomic factors that we have discussed till now, inflation, economic growth, I'm not directly trading in those factors. But majority of the time, the style related factors or investment factors, they are very dynamic. We keep trading with them. They keep changing with time. Especially when I look at the Fama-French model, this is a risk premium. Small minus big talks about the returns of the small firms minus the returns of the big firms. Returns of the firms with high market to book to market value minus the firms with lower book to market value. When the market does poorly, the stocks that are having very high exposure to market factor, they are doing badly. Correct? Overall market is poor. So not all stocks may go down in the same manner. Those stocks which have very high exposure with respect to the market, they are going to be badly affected. And those that are less correlated with respect to the overall market, they tend to be more or less stable. And the same logic as per the Fama-French, the other one that we are bringing in is small stocks minus the big stocks. We are talking about the differential returns of the small stocks versus the big stocks. So it has been observed that the small firms have been outperforming compared to the large firms. So that's another dynamic risk factor that we have to consider. Similarly, book to market values, those firms which were having the high book to market value compared to the firms that were having the lower book to market values, they were outperforming the market. But at the same time, if you look at the other side, small stocks, the volatility could be much higher because the liquidity is much lesser for them. Compared to the large stocks, the small stocks are more and more illiquid. So becomes very difficult to sell them at the price desired. Without compromising on the price, it becomes difficult to sell them off. So overall, I could see that in the long run, they may do a kind of a much better performance. But we can see that in short periods, there could be a period where they can underperform quite drastically as well. Now, it is observed that the size effect is actually getting disappeared. Whatever has come through the Fama-French model, the size effect of small minus the big, it is typically found that the size effect is slowly going out of the system, because it has been found that whatever the Fama-French model came out as the size premium, it is being observed that to a large extent the size premium whatever came out could be an impact of the data mining process, mining the data so deeply. So the pattern that has been observed that small stocks have been overperforming over the large stock is purely a scenario of data mining. Because one more thing, if you see, the rational investors, active investors, they keep playing on the news. So they bid up the price on small cap stocks, they keep buying the small cap stocks, and they keep shorting the large cap stocks. So internally you will find that the price of the small cap stocks keeps going up, the price of the large cap stocks keeps coming down. So the difference is completely getting eliminated in the process. So it's not a continuous, consistent process that the small stocks will give much higher returns compared to the large stocks. It is purely a scenario of data mining. So just for the case of high risk adjusted returns, it is advised that the asset owner should not simply switch on to the small stocks, because consistently they may not provide the higher returns, because the advantages of the mispricing opportunities would have already been exploited by various investors during the process. And then we are also talking about another kind of investment strategies which are momentum based. So this is purely based on the assumption of continuance of existing trend. So if there is an upward trend that has got started for a particular stock or for a sector, we see that this keeps continuously growing for some time. And similarly, when there is a fall that is observed, we see that the fall also keeps falling for some period. So this kind of a strategy is purely based on the concept of winner stocks continuing to win, losers continue to lose at least for some period of time. So the momentum investment strategy is simple. The trader will take a long position in that particular asset that is showing an upward trend, and he will take a short position in those assets which are showing a downward trend. That's a straightforward momentum investment strategy, right? And when we are talking about cross-sectional strategy, we are trying to group the stocks into two groups: winners versus the losers. Some things that are growing, some things which are losing. So in a cross-sectional strategy, we are always comparing the group of stocks of winners versus the losers. And when I talk about the cumulative profit on the momentum strategy, it has been observed that those who are following momentum strategies, the cumulative profits are much higher compared to those who are going ahead with the value investing strategy or the size based investment strategy. We are talking about cumulative profits on momentum strategies to be slightly higher. There is, sometimes it's also called as trend investing, because I am going to go with the trend. Anything that is showing an upward trend, I assume that it will show upward trend for some more time. So I don't mind taking a long position in that stock. Similarly, the downward trend, I will take the short position in that stock. Because momentum wise, we are looking at it as with the correlation. So that's where we are calling it as a positive feedback strategy, right? Because anything that is going up, we say it's better to invest. Anything that is going down, we say it's not good to invest. Whereas when I look at it, so the higher means invest, the lower means do not invest. That's how the momentum investment strategy comes. Whereas in the case of value, we look at it the opposite way. Low value, it's like good to buy. High value, it's already overvalued, so better sell it up. So that's where we call value based investing as a negative investment strategy, momentum based investing as a positive investment strategy. So going with again the momentum, so those stocks which have high past returns, it is expected that they keep going up in the future as well, so they become more and more attractive. So the momentum based investors are going to continuously buy them, and they keep going up in the future as well until a negative turn starts coming up. So they keep going up until a certain period of time. And this momentum is not just limited to equities and all, it is manifesting across all the asset classes, and an enhancement can very well be done to the Fama-French model to include this fourth component also, which is the momentum as one more factor apart from the market, the size and the value associated with the firms. So that's one more strategy that we need to look at based on the common factors. So these are some of the aspects which I thought I should cover as a part of this session. We have dealt with all these 5 points in much more detail. If you have any further queries on this, please feel free to get back to me by giving me a call on the number that I have provided below, or you can send in an email at the email address provided below. Thanks a lot for listening to this session. Thank you very much.